Today's topic, how to build a tax-efficient, taxable account as a physician. If you have watched our previous YouTube videos or you read our blog, you know that I love the taxable account. I often call the taxable account our utility player. What is this utility player and how can it benefit you? Well, I'm glad you're here because we're going to cover all that in this video. Stay tuned. That's all coming up next. All right, first up, give me the basics on the taxable account. So a taxable account is really just a brokerage account. So this is your traditional investment account, meaning it's not what we call a qualified account. We'd actually label it as a non-qualified account. And the most common forms of this taxable account are going to be either an individual account, just in your name, or a joint account. Traditionally, a joint account will be held with a spouse, but can it be held with other people? It surely can. But at the very premise of it, you're looking at those two usual setups. There are other ways that you could get it set up. And even when we list joint account, you could have more than one owner at some custodian. So at the bare bones, it's just a brokerage investment account. Now, the uniqueness of it is there are no limits on the money coming in. There are no limits on the money coming out. That is why I always call it our utility player. You can have one. You could have 20. You could have 5 for different goals. You could have one that's more aggressive and one that's less aggressive. There are a lot of ways to build this. And remember, when we use these account titles, they're just umbrellas. So you can own stocks in here. You can own bonds in here. Maybe you have some type of real estate in here. You can own precious metals in different forms of ETFs or mutual funds. So there's a lot that you can do with these accounts. At the very highest level of it, just realize that it's really just a brokerage account. Now, with that said, I'm actually going to scroll over to my blog post here, which we'll have in the show notes below. But here are some of the notes that we list as some of your biggest pros. No limits, I already covered. It's flexible. Coming back to that term, I'm going to use it a lot today. That utility player, it is flexible. Money in, money out, you have flexibility in there. No forced withdrawals. So as you get older, there's something called RMDs, required minimum distributions. Those are on your qualified accounts. They will not be there on your taxable account. No 10% penalty if you need the funds earlier. Usually earlier, we list as 59.5. So if you want to retire earlier, you're part of that FIRE movement, this would have a lot of accessibility to it. Now, there are other ways to get the funds before then. So that's why I don't always kind of push qualified accounts aside there, but just know that this one you'd have flexibility no matter what. You can pull it out at 35, 45, 25, you name any age, you can pull the money out. There's good taxes in here, right? Now, it depends on what's being held in there and how we're going to label it, but this is where you could have passive, you could have long-term capital gains, you could have qualified dividends. The losses can offset gains. Sometimes we call this also tax loss harvesting, right? So if you have a year where you have some losses, you might want to kind of rack some of those up. And if you have more than what you could accommodate to offset the gains, remember, you can also use up to $3,000 per year to offset your income, which is what I always like to label as tax arbitrage. You have depreciation in here. You have 199A deductions, no payroll taxes. So there's a lot of benefits inside of just the taxes, but it depends on what we're referring to, right? So I just make that caveat there that there's a lot of tax conversation in there. And then one of the best dinosaurs still out there, you get a step up in basis at death based on the current rules. So what does that mean? Let's just say you have $100,000 in your taxable account. That's your current value. So even if you bought it for $10,000 and depreciated up to $100,000, when you pass away, when it passes over to your beneficiaries, they get a step up in basis. So this is one of those ultimate tax plays, that one of those legacy plays on here, where the new beneficiary of that account would then have a new basis of $100,000. So for this example, where we were at 10, we went up to 100, that $90,000 that was really pent up capital gains has now been reset, right? So that's one of the beauties of this taxable account. Also one of the beauties of real estate as well, which we'll kind of cover a little bit in today's video. But those are the main benefits. That's your intro to the taxable account. Like I said, most commonly, you're going to see it as individual account or a joint account. If you're in one of the 18 states that allow an account called tenants by the entirety and you were married, you want to use the tenants by the entirety account title, not joint with rights of survivorship, because it's really just free asset protection. So we will cover that again a little bit later, but that's one that I always put out there early in these videos to make sure that we're putting that on your radar. So that's your taxable account. And now we'll start to walk through some of the more unique ways to build it and also take advantage of it. All right, so you have the taxable account. How do we pay less in taxes? Legally. Legally is the key here. So we're going to walk through two of our most common strategies that we're always thinking through in terms of a taxable account. Some of them are year by year, some of them are more legacy planning, but let's just walk through these to get started. So first up, very popular topic, tax loss harvesting. What does this mean? It means that you have some losses in your portfolio. Let's just say the overall portfolio you bought for 10, it's now worth 8. So you have $2 in losses in there that if you went and sold, you could harvest those losses. So that's what tax loss harvesting is. It's going through your losers and then debating which ones do you want to sell to lock in a loss. You can also repurchase them. You got to be careful here. There's something called a wash rule. I won't get into the details in the video, but get into the blog post that's in the show notes below. Last time we recorded this video was nearly 45 minutes long. I'm trying to do my best not to allow this to get to 45 minutes. So tax loss harvesting, watch out for the wash rule. But with those losses, if they're not going to offset gains in that given year, they can carry over from year to year. And then also you can then use up to $3,000 per year to offset your ordinary income. With us working with physicians, this is one of my favorite areas that I call tax arbitrage because you're likely at a much higher ordinary income tax rate than you are a capital gains rate. We're having a little bit of tax arbitrage there. So that's one strategy that we really like. So keep an eye on tax loss harvesting, review your portfolio usually later in the year. Don't wait until like December 30th. Usually get in there December, start to kind of look around a little bit. But tax loss harvesting, good not only for the current year, but also future years if you're going to carry forward any of those losses. And then the other topic we have on how do we pay less taxes on our taxable account is really what I call either die with it or donate it. And what we mean by this, I know it's a little bit morbid there. It goes back to what I noted in the first intro to the video, right? If you have an appreciated stock, so let's just say you bought WealthKill stock for $1. You were one of the early entrants now, but now it's worth $10. So you have $9 of gains in there, right? You bought it for $1, it's worth 10 today. Well, if you die with it, when it goes to your beneficiary, remember, they get a step up in basis. So their new cost basis is $10. So we just remove that $9 of capital gains. Another way that you could do this if you're saying, well, what if I want to do something before I die, Chad? Well, you could also donate it. Now, donating appreciated stock makes the most sense if you were already charitably inclined, right? I'm not trying to force everyone to become charitably inclined with this video, but you usually want to have some charitable habits before you go down this path. Or really, it doesn't, while it saves you some, it doesn't really save you anything, right? Because it's more or less something that you're being forced into now. But same story, bought it for $1, worth 10 today. If you donate that appreciated stock to a charity or something called a donor advised fund, what we call a DAF, DAF, you can also take advantage of that $9 of capital gains here. Let's just say you were going to give someone $10 on the street at holiday time. In this example, you said, you know what, I'm going to keep that $10 in my pocket and I'm going to donate 1 share of WealthKill stock. You still donated $10. You didn't have to pay capital gains on that 9. You kept the other $10 in your pocket, and the charity's just as happy because they're still going to get that $10 tax-free. So they're happy regardless. So we just kind of did this unique way to lock in the same $10 tax deduction for you in this example, because you were going to give $10 anyway. That's the key. You were going to give it anyway. But now we're going to give the stock instead. You don't have to pay capital gains on it, and you kept that $10 in your pocket, which doesn't have any capital gains on it, right? That's your basis. So that's why we like that. So those are a few ways to pay lower taxes on your taxable account, whether you're going to take advantage of tax loss harvesting on a year-to-year basis, or whether you plan to maybe use some donation from your highly appreciated stock or take advantage of a donor advised fund, or maybe you're just going to hold on to it and then you'll pass away with it, and then you'll pass that on with the step up in basis at that point. All right, so it is time to start building your taxable account. What are you looking for here? So at a very high level, there's really 3 asset classes that are most commonly held. Get crazy with, but 3 are most common. You're gonna have stocks and or bonds and or even some type of real estate holding. When you start to build with stocks, the first thing we're usually looking for is something called an ETF, an exchange traded fund. The way that ETFs are built compared to mutual funds, essentially there's someone in there early on called a market participant that makes the account more tax efficient. So we're looking for more ETFs than we are mutual funds in most circumstances. The other thing is with stocks, you're looking for low turnover. Now, if you're coming from the modern portfolio theory world, you're probably already looking for index funds. Index funds should have very low turnover. So that is one thing you're looking for. If you really want to get into the weeds, you also want to see what their distributions look like. Are they distributing qualified or non-qualified dividends? Ideally, we want more qualified. Now, while you think, why don't we just get everything qualified dividends? It usually rotates. In our blog post, we show one of the more popular Vanguard funds, and we actually list their distribution schedule on how they usually rotate between the two. Now, in that example with that Vanguard fund, they've actually done a good job of usually having the non-qualified be the lower amount and then qualified be the higher amount, but you just don't have a ton of control over that. So that's where I would say you're getting into the weeds there. But if you really focus on ETF, low expense ratio, which ideally that is coming with an index fund, but we have seen crazier things before. And then if you're trying to keep it more qualified, fantastic. But really the main goal is going to be there is that lower turnover ratio, lower expense ratio, and you should have a pretty good stock fund there. On the bond side of thing, for the most part, ETF's still going to win here. This is where I'd like to introduce you to a new term, if you've not heard it before, a municipal bond. The reason why we really like muni bonds, short form of municipal bonds, is because they are exempt from federal taxes. If your state is a high income tax state, you can also find them down to your specific state. California has their own. Pennsylvania has their own. I list them in the blog post. I'm going to use those two as my main examples now. But if you buy municipal bonds from the state of California, not only can you avoid federal taxes, you can also avoid state taxes. In certain states that also have local taxes, here I'll come back to Pennsylvania and then Philadelphia. If you bought a Philadelphia municipal bond, you could technically, and you live in Philadelphia, you could technically avoid federal taxes, state taxes, and your local taxes. So that's, again, really getting into the weeds there. But if you're just avoiding federal taxes, I think that's a huge win on its own. But keep an eye on that. Same rules here, looking for lower expense ratio, looking for index. And then if you need to get into your state, I know Vanguard also has those state-specific municipal bond funds. So does Fidelity, iShares. They all are starting to add in these deeper layers now on the muni side. And then on the real estate side, this is usually just in terms of if you want to add some type of a REIT, a real estate investment trust is most common here. That's what we've noted here. We note real estate because of how much physicians always love real estate. When we are usually building them on our side and have full control over it, we usually do not go out of our way to add in real estate, at least not in this account. We're bigger fans of owning real estate outright, better control, more control over the tax situation. But if you are really looking to add in some real estate, you could do that in this section as well. But as I'll note here when we get to the tax efficiency build of it, I don't really love real estate in taxable account, depending on what type of income that is spitting out. But we'll hit that next. Main goals here, stocks, bonds, real estate, and then it just depends on what your risk tolerance is, right? Is this going to end up looking like a longer term account? Is this a short term account? Is this somewhere in the middle of the road? That's also going to dictate how much stocks versus bonds you're going to have inside of this taxable account. Next up, the very popular and controversial topic of asset location. And I say that because while I know the proper way to build the most tax efficient portfolio, sometimes it doesn't always blend perfectly. Or as I note in our blog post, sometimes it's the siblings that love each other, but they still fight. So I'm going to walk through 4 core beliefs I want you to think through when you're building out your taxable account, but understanding there is going to be some flexibility here. In a perfect world, number one that I'm going to go through, in a perfect world, you have everything in your qualified account, right? You have everything in your 401k or your backdoor Roth IRA. The downside is if you're a high income professional, physician, attorney, dentist, vet, you likely need to do more than that, right? Just maxing out your 401k every year and your backdoor Roth IRA is probably not going to cut it. You're probably not saving enough. So unfortunately, and fortunately, depending on how you look at it, that introduces this taxable account. The second one that we list in here is kind of building on that same one. Tax qualified should be your higher ratio. It should be, but I can tell you from experience for a lot of our physicians as they work their way through their career, because there's no limits on how much we can save, it is not going to be uncommon or uncharacteristic for your taxable account to eventually outpace, in terms of just overall size, your qualified accounts. Because again, there's no limits to how much you can put into it. So you can really crank that up where you could put $100,000 into your joint account with your spouse. You can still only do $22,500 to your 401k in that given year. Now, there are other ways to build up your qualified assets as well, but for the most part, if you stick with those two, eventually your taxable account's probably going to catch up. Number 3, avoid taxable income in your taxable accounts. Now, we list 4 different ways, so it's kind of a set of 4 and then another set of 4 on ways that you're trying to build around this conundrum per se, right? And there's different ways you're going to build this depending on low interest rate, high interest rate, but your goal is to try to limit the amount of taxable events inside of your taxable account. And if there are going to be taxable events, you're trying to have more, let's just go back to what we did on the dividends, right? We're looking for more qualified distributions or qualified dividends as opposed to non-qualified dividends, qualified interest versus non-qualified interest. So those are the things that we're looking for most when we get into this. And then last but not least, try to avoid placing cells inside of your taxable account. And there are a lot of ways to work around this, right? Let's go back to what I said before. If charitably inclined, you can donate the appreciated stock. How about when you go to reinvest every single month, you're reinvesting in there to rebalance the account. So you're working your way to build up that basis as well. So there are a lot of ways that you can work to avoid placing cells or even build up your basis. So if you do have to do it, you're trying to make the actual gain portion a little bit smaller. The other way you could do this is maybe instead of investing to it, if you needed money out, maybe that month you don't invest into your taxable account, right? You keep that out because you knew you needed money. This is also where the emergency fund comes in, and not only just the emergency fund for a rainy day fund, but any short-term goals within 3 to 5 years. That's why this is all important. We're trying to build an entire plan as tax efficient as possible. So those are the 4 main ones. There are a lot of moving parts there. Again, I know I've said this a few times in this video, but I'm trying to keep this video from not going forever. Literally could go hours on this topic, but go into the blog post. We'll have some more details in there. We have more examples. We even have pulling in actual documents from the investor websites like the Vanguards and Fidelities to show you specific examples. So those are the 4 ways that we're trying to build this following the traditional asset location rules, but understanding there are going to be times where you're going to bend or even break those rules based on your unique circumstances. Coming down the home stretch, just want to finish with some estate planning, asset protection rules inside of these taxable accounts. So I know I said it at the start, but one of the first things I want you to look for is if you are married and you live in one of the 18 states that allow something called tenants by the entirety, you want your joint account to be owned tenants by the entirety. This is free asset protection without any fancy types of trust attached to it. So first and foremost, look for that. If you're in one of the other, however many states that ends up being, was at 32, right? The other 32 states, you don't have this luxury, and you do have to start to think about a little bit more complicated forms of asset protection, whether that is adding some trust in there. In the actual blog post below in the show notes, there's something called a domestic asset protection trust, something called a DAPT, D-A-P-T. That can be an option. Usually, at least for our clients, we'll wait for that number to grow a little bit higher to safeguard there, but then you're still putting in other asset protection where you can. Maybe it's something as simple as an umbrella policy, but I know that in the physician world in particular, we're always worried about that horrible medical malpractice suit. So you're trying to set up as many barriers as you can if this would ever go wrong where you're trying to protect those assets. So those are some of the most important ones there. Tenants by the entirety. I know I said it a few times as well. Step up at basis at death. So if you just say, hey, I don't ever want to pay taxes on it, your best thing to do, die with it. It'll get a step up in basis based on current rules when it transitions over to your heirs. I know I covered the domestic asset protection trust as well. Moral of the story, the taxable account is your utility player. There's a lot of flexibility. I know this is a shorter video on a relatively complex topic, right? You can really take this a lot of different ways, and that's what we're trying to at least give you the overview of that now. Keep in mind, taxable account is a great account to take a look at, and it can be and should be your utility player. And there you have it, building a tax-efficient taxable account as a physician. This is a complicated topic. There are a lot of moving parts. And while the account is relatively simple, it's as simple as we almost have this in every single one of our clients' financial plan, there are a lot of moving parts to it on how you're going to build it, how you're going to keep it tax efficient, how you might take advantage of some of the tax loss harvesting. Maybe it's some of the donor advised fund and actually donating the appreciated stocks. Maybe it's something as crazy as estate planning, right? On what's the best way to kind of transition this account, but a lot of moving parts. But again, it is your utility player. So main goal is this should give you the foundation to at least dig into this taxable account. Again, we love it. It's a utility player. There's a lot of ways to build it. But as always, thanks for hanging out with me for the last 15 minutes or so. I hope you got a lot of value out of this and at least maybe learned something new, whether it's to open up your first ever taxable account or maybe to refine your current taxable account. But as always, thanks again for hanging out with me. If you have not subscribed, now's a great time to subscribe. If you click this little bell icon, you also get a notification every time we release a new video. Again, thanks for hanging out with me, and I'll catch you on the next video.